Hello and welcome to today's RIMS webinar sponsored by Prudent Insurance Brokers Private Limited. Trade credit insurance, managing risk and promoting growth. My name is Justin Smolison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. We're very pleased to see you all. A few notes before we begin. If you have a question for the presenters during today's session, please submit them by writing in the question box. Feel free to ask at any point in the presentation. Our panelists will address as many as possible today, and they will also be gathered, and the Prudent team will reply to you directly. Following this session, the recording will be available on the on-demand events page of rims.org, and all downloads and contact information will be accessible to the sponsor. And on with today's presentation. RIMS is thrilled, and Prudent is thrilled to be joined by a large global audience. Our panelists have decades of experience between them and are here to explore the current trends and challenges in trade credit insurance. Please welcome our panelists. First up is Ms. Karishma Suvarna Gadia. Karishma is a seasoned professional with a strong track record in the realm of credit insurance. As the commercial and sales head at Panelist, India, she brings over 14 years of valuable experience in client management, retention, and new business development. Karishma's unwavering commitment lies in diligently identifying and delivering tailor-made solutions that perfectly meet her clients' needs. Next up is Mr. Gautam Gore. Gautam is an experienced professional with over 2 decades in financial management, especially in credit control and receivable management. Working with Panasonic Life Solutions India Private Limited, he has automated collections and credit management process through payment gateways, virtual accounts, and Power BI. Additionally, he brings expertise in process standardization and digitization. And we have Mr. Imran Khan. Imran is an accomplished credit insurance professional and brings with him 18 years of experience in banking and credit insurance, helping large corporates and SMEs in structuring insurance policies. Imran uses his experience in providing customized solutions to clients in better management of their account receivables. Client retention and exceptional service are his forte. And please welcome my friend and our moderator, Vignesh Chandrasekhar. Vignesh is a professionally qualified risk manager with a decade of experience in risk management and insurance. He has worked as a risk engineer and underwriter with a leading general insurer before moving into a broking role. He has been associated with Prudent since 2021 and helps drive strategy and engagement for large clients as well as various consulting initiatives. Vignesh, the virtual floor is yours. Let's kick things off.
Thank you very much, Justin. Good evening, good afternoon, good morning to all our participants from across the globe. It gives me immense pleasure to welcome you all to this exciting webinar on trade credit insurance presented by Prudent Insurance Brokers and RIMS, the Risk Management Society. Trade credit insurance, well, it's a risk management tool that protects businesses against the potential losses incurred from non-payment or insolvency of their customers. By mitigating the financial risks associated with trade credit, this type of insurance can enhance cash flow, improve access to working capital, and enable businesses to explore new sales opportunities with greater confidence. In today's webinar, we will aim to explore many of these areas with the ultimate aim of helping our participants better understand and appreciate trade credit insurance. To aid us in this, we have an esteemed panel of experts from diverse backgrounds, experiences, and positions. It is an honor and a privilege for me to be able to moderate this session. Now, before we begin, we would like to conduct a short poll to gauge the interest of our participants. You would momentarily be seeing a poll pop up on your screen, and I would request all our attendees to please participate in the poll. Once the answers start flowing in, we will share the results and then we will go ahead with our webinar over here. So I would request all the participants to please provide their votes. The poll should be visible to you right now.
All right, should be up there. Vignesh, would you like me to read the questions?
Sure, Justin. That'll help.
All right, question number 1. What would you want as a key takeaway from this session? Would you like to know more about the role of trade credit insurance in today's age of global economic slowdown, geopolitical tensions, and rising insolvencies? Would you like to know more about claim trends, guidelines, and associated challenges, future outlook, and a way forward for trade credit insurance, or possibly something else, or you're just not sure yet? We're going to let the poll go for just another 5 seconds. It looks like answer number 1 is the overwhelming majority reason why people are here. But we're going to wrap it up right about now. And there you go. Can you see that?
Yeah.
Okay, great.
Yeah. It's really interesting. Almost 70% of our participants would want to understand the role of trade credit insurance in today's day and age. Of course, we can see there is a lot of geopolitical tensions, a lot of rising insolvencies. So I'm not surprised that a lot of our audiences would want to understand about this. Well, the panel will try to ensure that this requirement is met as much as possible. And I guess the stage is set for a discussion on a fascinating subject. So let's get the ball rolling. And let's go first to our resident trade credit expert, Mr. Imran Khan, to get this discussion started. Imran, for those of us who are new to trade credit, could you quickly take us through what trade credit insurance is, what it covers, and what would be the benefits of taking such an insurance?
Thank you so much, Vignesh. Good evening, everyone. Thank you for taking out time on a Friday evening. So, in a very simple words, trade credit insurance is basically insurance of your account receivables. So, whenever someone is selling goods on credit or providing services on credit, they run the risk of non-payment by the buyer. This non-payment could be due to several reasons. So we categorize them into two major parts. So one is the commercial risk and the other one is political risk insurance, or in short, we call it as PRI. The commercial risk could be due to insolvencies, or it could be due to protracted default or delayed payments. Now, delayed payments could happen due to a cash flow problem of the buyer. It could be an intent problem. It could be a fraudulent customer as well. So all these reasons, which results in non-payment to the supplier comes under commercial risk insurance, and this is applicable for both exports and domestic business. The other part, PRI, the political risk insurance, is applicable for export sales whenever there is a cross-border trade happening between two countries. There are two countries involved. So now let us assume, exporter A, ships to a country like Russia or Ukraine, and there is a war going on between these two countries. They had a policy before the conflict started, and then as a result, the buyer, though he is available, the intent is to pay, but still he is not able to make the payment due to the political situation of that country, comes under political risk insurance. So there are several coverages under possible under PRI. For example, restrictions on currency transfer, we also call it inconvertibility. A war we just discussed, that can also be covered. It could be something like as cancellation of import license. It could be floods or a natural calamity in that particular country. It could be a civil war. So any reason other than the buyer's inability to pay, occurred due to the political situation in that particular country results in political risk insurance. There are several benefits to this insurance. All the companies which have taken these policies, they are benefited in several ways. To list some, it helps in better provisioning of their bad debts, which helps in their improved income. It helps in improving their cash flows. The exporters can enter into new territories, new geographies. As a new exporter, I might be shy to export into an African country or maybe a Middle Eastern country, but having a credit insurance, it gives me the confidence to grow my sales into new territories. Last but not the least, very important part is in case there is a claim scenario and the claim is notified. So all the collection action, the chasing the buyer, following up with the buyer is all taken care by the insurance company. So the exporter can focus on their core business, which is manufacturing and selling of goods or providing services, while the insurance company will try and recover the money from the buyer. Also, one more important part which maybe the audience would want to know, like every insurance, credit insurance also comes with certain exclusions. to discuss few exclusions in the policies. Most important is disputed debts. Whenever there is a commercial dispute between the buyer and the supplier, those kind of claims are on hold. Then in case of domestic market, selling to your own government, for example, selling to Ministry of Railways, Ministry of Health, that is out of cover. Having said that, PSUs can be covered under the policy. Any fines or penalties, incurred by the supplier on the buyer due to delayed payments cannot be, part of the coverage. Sales to your own subsidiaries, again cannot be covered because there is no risk involved. So these are some of the exclusions in the policy. I think as we go ahead, we'll be, exploring more into these exclusions as the, panelists discuss further. Over to you, Vignesh.
Right. No, thank you, Imran. I think that was a very good introduction to trade credit insurance for our audience. And, now that we have understood the basics, let's dive a bit deeper into the ocean of trade credit insurance. And no one better than Karishma. Karishma, we have generally seen corporates, asking questions on coverage for disputes. And Imran also touched upon the point of disputes as well. So how do you as an insurer convince clients regarding disputes? Because, disputes may be either genuine or they may not be genuine.
Yeah, thank you, Vignesh. Honestly, this is a very common question that we get. And amongst the biggest fears that we see that companies have, that if their claim will be outright dismissed on the basis of a dispute. Before I get into the question, let me just give a very quick brief on Atradius. Atradius is the second largest credit insurer worldwide, and we have been in operation since the last 95 plus years, with offices in 50 countries globally. In India as well, we were the first ones to start the product almost 20 years back. Now, when it comes to an overdue or a claim-like situation, what we say, the key is to get in early. The moment you have an overdue and it is 90 days old, you need to report the same to your insurer. What this does, it lets us get into the situation early, speak to the buyer, put in a payment plan in place, and take the case forward. When there's a third party like Atradius Selections who gets involved with the buyer, it's a different type of pressure that we're able to add. It's also the reputational risk that the buyer faces. It really helps us getting him to the table to negotiate the deal. If it is disputed, that is one. If not, he'll give us a payment plan. What we also see is generally we're covering the buyer for multiple suppliers. So it is the fear that it's not just the relationship between one supplier that's going bad, but it's also the fear that the insurer will remove all the lines for the rest of the suppliers as well. So it's completely going to block his working capital. It's going to block him getting supplies from anybody else. It's the pressure for him then to pay. In the last 1 year alone, we have helped collect 2,700 crores worth of receivables worldwide. And we've paid claims worth 5,000 crores. So those numbers technically speak for themselves. So while it's not a very black and white answer, despite disputes being a very clear exclusion in the policy, we do not dismiss a case because it's a dispute. We want to understand on a case-to-case basis what is happening. We try and get both the buyer and seller on the table and resolve it.
Right. Thank you, Karishma. I'm sure participants from the corporate side have got some key insights into this aspect regarding disputes. Well, speaking of corporates, let's hear from Gautam, who has been using trade credit insurance for many, many years. So Gautam, how has having a trade credit policy helped you in managing your credit risk and bringing in more hygiene in your internal credit control procedures?
Yeah, thank you, Vignesh. So no doubt, trade credit insurance is one of the critical tool to mitigate the credit risk associated with the sale of goods or services on the credit. It also helps organization remain focused on its own core business rather than worrying on the credit side. So having trade credit policy, it basically helps into two aspects. One is to support the business growth by providing coverage for credit risk. And it also helps in improving the internal credit control procedures. So while we all have seen tremendous growth in India over last decade, and having said this, at the same time we have also seen uh, uh, quite a serious ups and downs in the economy as well. Particularly in India, if we see right from demonetization to GST implementation and COVID-19 worldwide impacted economy to a large extent. Such events also influences the cash flows and the increases the risk of credit in the market. So, however, I think business we cannot have that kind of flexibility to stretch inward or outward to that extent, and we are also not an expert in predicting the such economic environment. So, according to the normal procedure, business we should allow to grow, and having credit policy. If someone is sharing your risk, basically, you can also increase your growth. So it helps in business in that sense. And second topic, you said about the bringing the hygiene in the internal credit control procedure. So this is absolutely true. We have been having this credit policy, insurance policy for more than around 10 to 12 years now. And we have seen the credit procedures improving year on year, and it has become more robust now. So, primarily the reason is insurers generally have access to the large database of credit and the risk assessments. They can also provide valuable insights about the buyer, their credit worthiness, and in turn it helps us to take a informed decision, and we can minimize the risk about from those buyers. Second point is we can also have leverage the insurer's credit assessment and analytical capabilities. They can provide recommendations on credit limit. They can also provide recommendations on the credit days or basis their risk profile. So that also helps in assessing the buyer and credit risk associated with those buyers. So next part, if I say the insurer also once having the policy, they actively monitor our portfolio, and they also give us a time-to-time feedback or early warnings if they come across any such negative information about any particular buyer. So we can also plan our credit exposure in a controlled way, and we can also take a preventive actions to control the credit or reduce the number of days, or probably improve or maybe tighten slightly the collection process. So that way it can help corporate to further improve their credit procedures. At times, credit insurer can also rein in the over-aggressive company by limiting their coverages on particular buyer or to appropriate level. So that can also help us analyzing whether we should really go fast about those buyers or not. So overall, if we say having trade credit insurance is definitely helping our internal credit procedure, as well as it supports business by sharing the risk. Yeah, over to you, Vignesh.
Right. So Gautam, you had mentioned about insurers. So as with most insurance policies, there is a requirement for providing various reports and information to insurers. So as a user of this product for more than a decade, what are the challenges generally client faces to provide the information that is required by insurers on a regular basis?
Generally, if you see the requirement document requirement is not that complex, to be very honest. I mean, if our policies or internal processes are aligned to the policy requirement, then those are very normal documents which is required by the insurer. Maybe some of the typical challenges what we had faced in early days when we started the program, like availability and accuracy of data, and time and resource was also a constraint. We had to dedicate 1 or 2 members for that. Frequency of reporting was also quite challenging, like monthly, quarterly, half yearly, so on. However, I think given in the current scenario where the technology has evolved to a great extent, and we can take advantage of technology and automate many of our procedures, basically, to align our ERPs with the credit policy requirement. So we can analyze, we can report the required information in a real-time basis, and we can also avoid any misses on the timelines. So that also helps. Second part, I would say, we need to establish our internal communications also. I mean, we need to clearly communicate what are the expectations from our internal stakeholders, like, say, for example, sales function or, finance function or credit function. So we need to have internal communication very transparently and clearly. What is the expectation from each function with respect to the document or the other documentation or information is concerned. So third point, I would say, we need to regularly, review and update our procedure, whether it has to be, whether it is in line with what is required in the policy, or we are going off track. So we can align ourselves in the procedure also into the requirements. Finally, we need, it's needless to mention that we have to have a strong relationship of trust between the insurer and the corporate, so that we can have see clarity. We can address. I mean, they can address any concerns with respect to reporting lines are concerned. So yeah, overall, I don't see any challenge in terms of documentation. Only thing is we need to align our real operations with the insurance policy. Then it becomes very easy.
Right. Thank you, Gautam. I think you mentioned a few key points which our participants from the insurer fraternity can take note of. And, going back to an insurer's perspective, Karishma, we are in, of course, a regulated industry. And in the latest changes in the IRDA guidelines, we have banks, NBFCs, and financial institutions who can now take a trade credit policy. And we do have a lot of participants here from those industries. So can you elaborate a bit on this aspect and how corporate clients and banks can benefit from this new guideline?
Sure. So when trade credit actually started in 2001 and all the way up to 2010, almost 60% of all our portfolios were bank-driven policies. It was where banks, NBFCs, factors covered the entire funding factoring portfolios. In 2010, essentially, because of a certain claim-like situation, the regulator put a stop on banks and NBFCs then buying the policy. Cut to 10 years later, September 2021, after a lot of lobbying, the regulations have now opened up for banks, NBFCs, factors to avail trade credit. For us, it's a huge step to boost the economy in the right direction, to avail better funding and financing. So how does it actually help? Firstly, for banks and factors who are funding their portfolios, who are factoring their invoices, it helps cover the entire risk of that portfolio. Secondly, it helps strengthening the lending portfolio. So essentially, when banks lend, NBFCs lend, you lend ideally to the top tier. With having a trade credit insurance policy, you're able to widen that net. You can go one layer below. You're not sticking only to the AAA rated and everything. But the most important factor that we feel is the overall improved credit availability in the system. Now, SMEs, MSMEs, corporate clients should all be able to finance their receivables at a better competitive price as compared to not having the policy before. It should give more confidence to the banks and financiers that the portfolio is covered. They should be able to leverage the policy in that manner. So this is how we expect the industry to grow.
Right. Thank you, Karishma. You brought forth some key points. And continuing a bit more on this topic, what are some of the challenges that are being faced by banks and, for that matter, for an insurer in underwriting such programs?
Right. So I think the main challenge or the disconnect that we're seeing today, and we're working very closely with everyone to try and see how to mitigate this, is on the reporting timeline. So now for a bank, NBFC, factor, they have to report the NPA at 90 days overdue. Under a trade credit policy, they are going to get paid out at 6 months. So there is this gap. That is something that is causing a hindrance. The second thing is also the maximum liability under the programs that is required. when a bank is funding, they want the entire funding value to be covered as the maximum liability in the program. What it does from a reinsurance angle, it increases the cost quite a bit. So we're trying to see how to mitigate that. But in my opinion, the biggest hindrance today is not having capital relief. The RBI today does not offer any capital relief to banks, and there is active lobbying ongoing to see if this can be put on the table. If you look at all the international markets, capital relief is very much there and is allowed for banks when they are using trade credit insurance. We believe if in India as well, we're able to bring this about, it's going to really help.
Right. No, I agree with you, and I'm sure our industry and the country is going in the right direction towards a solution to these challenges. Now, I'm sure we'll all agree that, the real test of any insurance policy is at the time of a claim. So let's talk a little bit about, the claim-related aspects of trade credit. So Gautam, as a client, what has been your experience in claims? Without, naming any buyer, can you talk about typical claim scenarios and how the policy has responded?
Yeah, so Vignesh, it has been a mixed bag about experience. So as you know, we have been using this policy for quite some time now, and we have also seen ups and downs in the economy also over last 10 to 12 years. So we certainly had a few claims, no doubt, and by and large, the experience has been quite standard, and it has been fairly straightforward claim settlements over these periods, whether it is small value case or high value case. Having said this, we also have experienced certain frustrating time as well. So few claims were really frustrating in terms of the response or technicalities or from the uncleared conditions. So, but over a period of time, it has understanding has also been refined with the insurer, and the typical examples why the claims get onto difficulty mode is sometimes we also do over trading. The approval limit is X, and we do trade X plus something. So then definitely it has some challenge, and we don't get paid for the overbilling. Then we also sometimes misses or overlook the internal credit policy procedure, and we bypass that. So if it has not been declared and communicated to the insurer, then it also again goes into the confusion state. And then also if there is any gap in reporting timeline, then also it deviates from the policy which is required as per policy. So however, I mean, having said this, one thing is very clear, and I'm very clear in my thoughts about by each passing claim, we also learn something new, and it leaves behind some experience which pushes us to the process improvement or the way of handling the claim or the credit. Even it also helps us the improving our credit control procedure, and it has been evolved over last 10 years, and it has become more robust now. To be very honest. And however, we are still in the living in a VUCA world and full of volatility and uncertainty, and business has to run. So we can, with all the checks and measures, we can minimize the risks by putting all the stringent procedures and policies. But we really can't prevent it completely, and that is why we need a partner to share the risk. So that's it. Yeah, thank you.
All right. Thank you, Gautam. I think those are some interesting claims scenarios that you have shared. Karishma, do you want to also jump in and share some of your experience when it comes to claims?
Yeah, I'm sorry. So I think with trade credit insurance, right, it helps essentially in two main factors. One is to help the corporate to sell more. It should be used as a leverage to be able to sell more, to increase your sales. And secondly, take an informed call on your buyers. But in case something goes wrong, then you have cover that backs it as well. With claims on a yearly basis, we see a good 200, 300 claims getting reported to us. With notifications, we see close to 500 notifications that we see on a yearly basis. For any insurer, it is very important to pay claims. We cannot not pay claims. That's why we have a policyholder who has taken, insurance. To Gautam's first point on there is delay sometimes. Yes, with insurers, I'm not talking for me, but I'm talking on everyone together. Right? When you receive, especially in times of crisis, we receive a very large number of claims at that time. And yes, there are times where these timelines can get unfortunately breached. But if we keep that aside, on a general level, within 30 days of receipt of all claim documents, we should be able to assess and pay out. So that is the timeline that we technically follow. Purely from a claims perspective, we had seen over the years the claims have been rising. But COVID was one anomaly in this whole situation. When COVID started, we had a huge number of claims. As a Tradius, we had to increase our provision multiple times. But what we saw is collectively, everyone became more prudent also in their entire processes, which led to a lot of these claims then getting automatically cleared out. Cut to what we see today. From last year, I have already seen a 91% increase in notifications. Now, will all of these notifications land up in claims is something that is still to be seen, but we have seen that gradual increase because now we've gone back to the old ways of doing business. We're more, lenient in giving credit. So we see the number of claims also increasing. That being said, the main aim of any insurer is to have seamless claim experience. So that is what we all work towards.
Absolutely, Karishma. I think we are there to help ensure that the claims flow seamlessly. And I think our participants, I think they'll be benefited by hearing insurers' perspective on claims. Well, let's not leave Imran out from this discussion. So, Imran, would you want to share a few points regarding claims?
Sure, Vignesh. So, as a broker, since we manage multiple policies from different sectors, be it IT, pharma, IT distribution, textile. So, we have seen claims in both domestic and exports market. As a broker, it is our responsibility, that we make sure that the policy is underwritten well and explained to the client well as well. So that in case there's a claim scenario, we get the reportings and what Karishma was mentioning on time. To give some examples, we have seen claims in India, most of the businesses, large businesses, and especially in sole proprietorship, partnership firms are owned by an individual, the head of the family. So there have been situations where the demise of the sole business owner, the family was not able to, run the business, and that resulted into claim. We have seen claims where the business owner, due to their cash flow problem, where it occurred that, in order to make some quick bucks, they diverted their funds from the business to a government project, maybe into land or some other contract which they got, and the money got stuck, which ultimately resulted into claim. Similarly, we currently also we are managing one claim, which is almost 3 to 4 crore rupees, for a pharma client. So in this case, the supplier and the manufacturer, they had almost 10 years of relationship. And this is what we hear from our, prospective buyers that, we know our clients so well, we don't see any challenges. In this particular scenario, what has happened, the children of the owner, have settled abroad. He is almost 68 years old. He does not want to run the business and he's winding up his shop and he is looking for a seller to buy his business, which is not so easy for him to sell the business. And, almost 4 crore rupees of our client is stuck, which we have notified the claim, and hopefully it will get paid as well. So maybe once he is able to sell, the recovery may happen, but still for the client, they cannot wait for very long. And, these are some of the scenarios, which I just discussed. We have seen, various types of claims. So, yeah, it's a, policy which does happen. which does help, all the clients whenever there's a claim scenario. And it pays well, that is my experience.
Right. And Imran, as a broker, a prospective client, you must be coming across many queries, or sometimes clients that have doubts or apprehensions with respect to the policy. So can you discuss a few, and what would be your response to them? Because I'm sure a lot of people in the webinar may have similar queries, and many of them could get a response over here.
So it's an interesting one. We meet clients, day in, day out, different kinds of clients. So I'll just list out some of the general queries which we come across from the client. The most important is because most of the policies in India are whole turnover policies where your entire credit turnover is covered. So the first question we come across is, why do I need to cover my entire turnover? Can I pick and choose, certain buyers and take a policy? Why do I need to cover my good buyers? I have large corporates like Reliance, Birla, Mahindra, and so on and so forth. I don't want to cover them. Then we get queries, whoever does not want to pay will create a dispute, which we have already discussed. And in my experience of 10 years into credit, I have hardly seen, that there is a claim scenario and the buyer is disputing a debt. So there are situations where the intent is bad, the customer is fraudulent, they may try to create a dispute, but we see this question so often, but actually in real scenario, we do not see that, our disputes are being raised often, because you have proper documentation in acknowledgement of debt and everything is there. So this is, a question which we keep hearing. Also on the claims payment timeline, 180 days is too long. It's almost 6 months before we get paid, and also there's a credit period involved which he is offering initially. So to answer to some of them, pick and choose in the domestic policy is not allowed. You have to cover your entire bouquet. That is what the insurer also want, that I get the good, bad, and not so good risk, and that is where it is insurance works on the averages. Having said that, in case you have different segmentation, the exporter has different segments. Let's say they are into manufacturing of pharma chemicals and they are into manufacturing of agrochemicals as well, and they want to cover one of them, that is possible. If the supplier is selling into domestic market and exports as well, they want to cover one particular part of it, maybe just the domestic portion or the exports, that is also possible. Having said that, ECGC as an insurer does allow, in case of ECGC only does exports credit insurance, so they do allow single buyer exposure policies where a single buyer can be covered. But lately, ECGC also has seen a lot of claims in their single buyer exposure policies. So that's why they discourage, exporters to just apply for single buyer exposure policies. And also, it is not so easy to get a single buyer exposure policy, because if I, as a client or an exporter, is seeing a risk in a buyer in a particular country, same risk is seen by the insurer as well, and maybe in more depth, they want to study the financials before a limit is granted and a single buyer could be covered. As far as claims waiting period is concerned, the insurance company is not a bank. They want to assess the claim. They want to appoint a debt collection agency. The debt collection agency will chase the buyer, do soft calling, do the follow-ups. So it's generally not too long before a claims get paid. So it is important that the claim gets paid rather than it is, there's a delay of 180 days. These are some of the queries, which we hear from the clients. On the, once the Russia and Ukraine conflict started, we got a lot of calls that we don't have a policy, but we are exporting into these countries. Can, our risk be covered? So all the clients who were having a policy and were, already doing business with Russia and Ukraine, they were fully covered. It was a political risk situation. But for a new client, it is difficult because already there is a conflict going on. So no insurer would want to cover. In the end, I would like to add one important point here, that, companies take various kind of insurance. It could be, their property, fire, marine, industrial, all risk, EB, etc. But account receivables, which forms almost, 25 to 30% of their current assets, is generally uninsured. Clients in India take a lot of time, thinking, well, it's not mandatory also, that whether we should go and take it or not. So my suggestion is, given the changing global economic scenario, changing dynamics between countries, it is, imperative that the organization start considering TCI, sooner than later. Yeah.
Thanks, Imran. I think that has would have cleared a lot of doubts in our audience's mind. And I think, we have looked at the past in a way, we have looked at currently what is happening. Let's also, crystal ball a bit and look to the future. So, Imran, starting with you, what is your view on the future of Indian trade credit business? And any words of wisdom you would like to share with the audiences who are exploring trade credit?
So Vignesh, I'll say around 2017-18, the business size was almost 200 crores in India, which is close to 500 odd crores. I'm just talking about the private insurers between, ATDS, Kofas, Tata and SBI. The book size is almost 500 crores put together for the credit insurance, and ECGC is almost, 1100 crores. The way our economy is growing, it is one of the most robust economies presently. And the situation going on in, US and Europe, lots of insolvencies, and there's 60% rise in insolvencies in US. So the future, of course, I can simply say the future for credit insurance is bright. Clients, initially in my early days, it was only educative selling. We used to meet the client, educate them, and then they would forget about this product, and then they will call once there is a claim. Now the trend has changed, during COVID, post-COVID, that clients are sincerely thinking of taking this policy. So we have some large IT clients which we never thought will take a credit insurance policy. So in all the sectors, since the growth is there and the global economy is continuously changing, evolving, the product is going to grow, and the client should definitely consider having a trade credit policy in their portfolio.
Right. Thank you, Imran. Karishma, would you also want to share a few points on the future of trade credit insurance?
Okay. So I think I'm, pretty much aligned with what Imran is saying. We've seen this sector really grow in the last few years. Atreides itself has had a doubling effect in the last 5 years. So it is one product that we feel can really help boost not only exporters, but also the domestic business. Previously, business used to happen with people that you know. Now everyone wants to grow at a faster pace. They want to start exploring newer markets. So this is a very, apt tool to help you do the same. So in our opinion, the next few years are very much an India-focused years, and trade credit is one of the regions that's really going to grow really fast.
Absolutely. And I think the future really is bright for trade credit insurance, and I would say the Indian insurance market in general. And, just I'm looking at the time, we are 45 minutes into our webinar here. So I think that was a very informative and insightful discussion. And I'm sure our audience would have got a lot of interesting points to take away. And well, that brings us to the Q&A, the question and answer part of the webinar. I'm sure many of you who have attended this webinar will have queries which you would want answered. In case you haven't done it yet, please do post your questions in the Q&A section, and we will take up the questions from there. So we'll just give about a minute or so for a few further questions to come in, and then we'll, pick the brains of our panelists with our questions. So please do put your questions into the Q&A.
Evolution, whether you're an individual or an organization, has a tendency to be driven by challenges. Challenges that have an inherent element of uncertainty. There are events that become the turning points of global economies, and only the fittest ones survive, pre to post such events. And now, even before economies could recover from the pandemic, a geopolitical event has taken place. Studies have shown a steady increase in volume and complexities of risks, higher than ever before. The world is now a global village. We're so fundamentally connected that the impact of regional disasters can no longer be contained locally. The emergence of a different operating reality has caught the incumbent executives and directors unaware. The challenges ahead of them is to manage the downside of the risk better so that they can maximize the upside and hence be future ready. But these are the challenges that most of them have never faced before in their careers. At Prudent, we not only understand the world of risks, but also your business. We understand all the scenarios, know how to assess them, can prepare you for them, and help you control risks. We see it as part of our responsibility. Effective for traditional to new age, mid to large corporations, think of us as your trusted partner that mobilizes specialists in every field to make your risks manageable. For more information on customized solutions for your organization, log on to www.prudentbrokers.com.
Right. And we have had quite a few number of questions come in. I don't think, given the time, we'll be able to cover all of them. Of course, we'll try our best to do that. And those questions that we're not able to answer, we'll of course reach out to those of you who have posted the questions with the answers. So I think let's get started. Karishma, I think this question is for you. Given the global uncertainty, what is Atreides' approach towards buyer underwriting? And there were a couple of other questions on underwriting as well. So maybe you could give some view around that.
Sure. So honestly, nothing has changed in our underwriting approach. When we look at a risk, we start with the country, then followed by trade sector, followed by customer. It is very important for us to see who is the customer, who is he trading with, how strong is his relationship to the buyer, followed by transaction details, and then we go to the buyer. We look at the financials, we look at the trading history, we look at his market repute. We look at not only the soft information, not only the hard information, but also the softer information that we're able to gather. Based on all of this, we take a case-by-case approach and we're able to assign limits. Even during the pandemic, where the mandate for every single insurer was to reduce exposure, we really pride ourselves in saying that we only have to withdraw 1.2% of our overall global exposure, which is a very, very small amount. What we did was we worked very closely with our customers to see where there was error in the limits, which were the buyers they were not trading with, and those were the ones that we withdrew. The buyers where they wanted us to support, we continued supporting them.
Right. Thank you, Karishma. Next question, I think, Gautam, this would be relevant for you. How has been your experience about limit acceptance and TAT, turnaround time?
Yeah, so I think this is a good question. So it's very important for a corporate to have a higher acceptance ratio. So basically, acceptance ratio is nothing but the credit limit accepted by the insurer basis our request or our requirement. By and large, our acceptance ratio has been quite satisfactory, barring very, very few cases where we have a difference in the understanding, and it is also understood by either side. I mean, either from corporate or from insurer. One has to understand the other side, and then we arrive at the middle point. So yeah, overall, our acceptance ratio has been above 90%, which is considered to be a fair in the industry. So yeah, we have fairly good experience all throughout the year.
Right. We are also getting
coming.
Yeah. Sorry.
Yeah.
Go on.
About the debt. So turnaround time is also quite good in terms of whether it is weekend or month end. So the response time has been quite good, impressive.
Right. We are also getting questions regarding claims. So, Imran, I would like you to jump in here. What are the documents that are usually required to settle a claim?
So Vignesh, there are two questions. I'll take them parallelly. One is what are the typical cases where claims are rejected by insurance companies, and then what are the documents required to settle a claim. So typical cases, where the claims get rejected by the insurance companies are, there's a buyer, where a limit is assigned to that particular buyer, and then you start doing business with them. So there are 2-3 scenarios where a claim get rejected. One is you have started doing the business, already started invoicing the buyer without taking the limit on the particular buyer, and then realized at a later stage that limit you have not taken, and then you apply for a limit. Even if the limit is, granted, so whatever invoices you have done before the limit was granted, those claims can be rejected. Second is also the insurer wants you to stop shipment after a particular period of time. Let's say there's an initial credit period of 60 days, and then you have, used that 60 days, they give you additional 60 days, of extension period, or they also call it as C shipment, where you can, follow up for the payment and continue to do billing as well. But post this additional 60 days, if whatever shipment you have done, and you have not stopped the shipment or not taken the permission of the insurer, so anything above 60 plus 60, that is 120, whatever other shipments you have done, that will be rejected or not considered by the insurer. Second is also some claims comes under the category of DCL, some we call it as a discretionary credit limit, where the insurer gives the underwriting pen to the client itself, and that up to a particular limit. Based on your internal credit control procedures, we will be, assessing the buyer in case there's a claim. And let's say the client has given in the beginning that we take PDCs from each and every new buyer, and they go ahead and sell to a customer without taking the PDC. The insurer might reject the claim that you are mentioning that you definitely take a PDC and you have not taken in this case. So these are some typical scenarios where the claims get rejected, or if the reporting is too delayed, even though, I can say for a TDS, if you have reported, there is a delayed reporting, you have a reason, they do consider, that is good quality about them. But if the delay is beyond a, reasonable period of time, the claim might get, repudiated. The claim documents, because of the onset of GST in the domestic market also, we have most of the documents available, the claim form, the copy of invoice, proof of delivery, the statement, the last 12 months ledger, copy of invoices. These are some typical documents which are required in times of claims. We also advise clients to, try and follow for the payment through email, so that in case, let's say I write to a client, say your payment is due, and he says, I will give you after a month. Later on, he denies that, the goods are not good, or, I don't owe you this money, I never realized the good, this one email can help where he said, I will make the payment, and later on he's trying to, not pay to the client. So these are some of the, major claim documents required to help settle a claim. And in case of exports, generally documentation are very clear, because to do exports, you have the BL, the BE, packing list, copy of invoices, insurance, and all the documents are clear. So it's very easy to pay a claim in case of an export scenario.
Right. No, thank you, everyone. I think that would have given an answer to a couple of the questions that had come in with regards to claims. So we have another question, which is very interesting in my view, at least. Are startups or upcoming firms buying trade credit insurance policy? Because generally the policy periods will be for a year or based on transactions. Karishma, would you want to take a shot at this?
Yeah, I'm sorry. Actually, we've seen a huge mindset change. So if I look at how trade credit was evolving these few years, we didn't see too many inquiries coming from startups. But in the last 3 or 4 years, there's been a huge momentum in startups asking for trade credit insurance. It's essentially the funders who wanted to make it as a mandate to have their receivables secured. That's why we see a lot of inquiries coming from the startups. We see a lot of inquiries also coming from large listed companies, which were not coming earlier. We used to have bulk of our portfolio sitting in the mid-size, but now we see larger and larger corporates also coming into trade.
Right. Absolutely. I think given the, situation that we are seeing across the industries, more and more startups are coming up, and I think this will is a product that they should technically consider as well. So I think we're almost reaching the end. So given the paucity of time, I think the other questions that we were not able to answer in the Q&A, we will surely get back to you guys with the answers. And I think we all would agree that this has been an insightful and informative session. And before we conclude today's session, we would just be putting up another short poll so that we can curate more such informative webinars and sessions for all of us to learn from. So I would request all our participants to just provide their answers to this short poll, which would help us planning for future events as well.
All right, I'll read it aloud for everyone. Give Vignesh a chance to catch his breath. Which topic should we explore in the next webinar? Natural catastrophe risk management, parametric insurance, cyber insurance, or a session on risks pertaining to a specific industry? We're going to let the poll go for another 10 seconds or so. We'd love to hear from you all. We're seeing some great engagement. We got some great engagement during the Q&A session, during the video. So obviously you're all at the edge of your seats today. This is excellent. It's a great way to end the week. All right, Vignesh, you ready? It looks like cyber is going to be the overwhelming favorite, but Nat Cat also obviously always on people's minds. Here we go. Can you see it?
Yep, absolutely.
All right.
And yep, so cyber insurance, natural catastrophe risk management, definitely two risks that are at the top 3 in most of the global risk reports. And these are 2 areas that we are definitely focusing on. And you will shortly see some work and events coming in on both of these topics. Well, that brings us to a close to this webinar. And I would like to thank our panelists today, Karishma, Gautam, and Imran, for sharing their experience and knowledge with us. I'm sure our participants have gained new insights on trade credit insurance. And I would also like to thank RIMS and Justin for enabling such a smooth session to go on. And also, of course, our participants for providing us with such insightful questions. And again, for those of you whose questions we were not able to answer, we will surely reach out to you over email. And if you have any queries, please do reach out to us at our email ID, consulting@prudentbrokers.com, and we would be happy to assist you. That's it from my side. Justin, back to you to conclude the session.
All right. RIMS would like to thank our panelists, Karishma Suvarna, Gautam Gaur, Imran Khan, and our moderator and my friend Vignesh Chandrasekhar for their fabulous insight today. And we'd like to thank our audience. Of course, we have your questions from the Q&A, as Vignesh said. And so any that we couldn't answer today, Prudent will reply to you directly. And the answers to the final poll question, we have that. We'll keep that in mind for the next RIMS Prudent webinar. Visit prudentbrokers.com for more information. See the videos page for past collaborations. Learn more about RIMS India through the community page of rims.org. Click global and follow our group on LinkedIn. We are at India RIMS. Oh, very important announcement. Get your passports and visas ready, folks. Mark your calendars now. Risk World 2024 will be held in San Diego, California, May 5th through the 8th. The call for educational sessions was just announced. We want to hear from you, so visit rims.org/events to learn more about the world's largest risk management event. RIMS is global. We would love for you to build your network with us. Visit rims.org/membership to apply for a RIMS membership. Thank you all. This was a wonderful session. Have a great weekend and stay safe.